Welcome everybody to BDO's webinar focused on professional service firms. My name is Anna Gerald and I am the tax partner leading our professional services tax team in the UK. For those of you who don't already know, BDO is a global accounting network with over $8 billion in revenues, providing auditing, accounting and taxation services in 162 countries with over 74,000 people. You may have also heard at our news that BDO and Moore Stephens are in advanced merger discussions in the UK. Once completed by spring 2019, BDO will have a combined revenue of $590 million delivered by around 5,000 people across the UK. But back to more current matters and VAT, which is what you've all tuned in to listen to. Our speaker today is Michael Ashdown, who is the director in our VAT team and works with a number of professional service firms, and without him we would be lost on VAT matters. If you've got any questions, please do ask them during the webinar. There is a Q&A feature which is in the top right-hand corner of your screen. We will address as many of the questions as we can at the end of the webinar, or if time doesn't permit, after the webinar. We're also recording, and we'll email you the slide deck as well as the link to the recording in a few days, and we will finish within the hour. I will now hand over to Michael.
Thank you, Anna. The slide on the agenda shows the topics that we are going to be talking about this morning. Some of these are new topics which came as a result of announcements in this year's budget. Some of them are big issues at the moment that many businesses need to be considering, such as making tax digital and Brexit. And others are areas where we are seeing a lot of interest and attack from HMRC, such as the treatment of VAT and disbursements and land-related services. And we'll finally cover some other areas which we know HMRC always look at when they come out on routine visits. The first big issue to talk about is making tax digital for VAT. You will have seen a lot about this in the professional press and from HMRC, and it is a project which will affect most businesses from next year. It is a flagship project for HMRC, and the aim is that all taxpayers will be using Making Tax Digital for their interactions with HMRC going forward. As you are aware, there is a great push from the tax authorities for digital communication. We know that employment taxes has real-time information that is provided electronically to HMRC. And under the Union Customs Code, throughout the whole of Europe, all communications with the customs authorities have to be by digital means. So in the UK, VAT is the first step in a series of taxes which will be subject to Making Tax Digital. And as we said, this is the first step in the long-time goal of HMRC of requiring real-time information on individual transactions to be provided, though that is not the aim at the moment. What Making Tax Digital introduces is two new requirements. There is a new digital filing requirement and a record-keeping requirement, with digital records being required. And this will be compulsory for all businesses VAT registered in the UK that have a taxable turnover over £85,000. It only currently applies to businesses whose taxable turnover exceeds £85,000, so anybody who happens to have exempt outside the scope turnover or is registered on a voluntary basis will not be mandated yet to come into Making Tax Digital, so they will join the scheme later on. Making Tax Digital starts for most businesses for VAT periods that begin on or after the 1st of April 2019. That will mean that for businesses on monthly returns, it will be the April 2019 return that will be affected. But for most businesses, those businesses who complete the usual quarterly VAT returns, the first return to be covered by Making Tax Digital will be the June 2019, the 0619 VAT return. HMRC has announced in the last few weeks that the mandation for making tax digital has been put back to the 1st of October 2019 for businesses that are either complex or who are not established in the UK. And HMRC regards businesses as being complex if they are in a VAT group, if they have to make a payment on account, or if they are a government department. HMRC expects about 3% of the taxpayers will be in that complex definition and be put back to October, but for all other businesses it will start from the 1st of April 2019. There are very limited exceptions to the requirement to use Making Tax Digital, and those are as a result of age, disability, or people who have religious objections to the use of the internet. These have mainly stemmed from a tribunal case that HMRC lost last year on the requirement to use a digital means to submit the returns by the government gateway. HMRC expects to send out information, though, by the end of this month to any business which is likely to be put off till October. So unless you receive a letter, you are likely to be in the scheme from the 1st of April 2019, and businesses who are complex should receive notification by the end of December 2018 that they are not required under the scheme. As I mentioned, there are two requirements under Making Tax Digital for VAT. There is a requirement for a use of functionally compatible software to submit the VAT return information, and all of the VAT information and data needs to be digitally linked, so that it is therefore possible for transactions to be traced from the source data through to the completed VAT return. There are two sort of separate dates when these requirements come in. The first requirement to use functionally compatible software which utilises an API or Application Programming Interface commences in 2019, either the 1st of April 2019 or the 1st of October 2019 for businesses that are complex. And from that date, you will not be able to sort of re-key the 9-box VAT information into the government gateway. The use of the government gateway will cease, and you will need to ensure that your software is able to talk directly through the API to HMRC's software. So the aim is to avoid errors which HMRC consider arise from information being re-keyed from the information that has been calculated. The second requirement, the digital keeping requirement, which is also a part of Making Tax Digital, is subject to what is described as being a soft landing period, and that will commence from the 1st of April 2020. So the requirement to use the software starts in April 2019 or October 2019, and the requirement for all information to be digitally linked subject to the soft landing and will commence in April 2020. There has been some discussion about whether HMRC will allow complex businesses a whole year from October 2019 to comply with the digital record keeping requirement, but as of yet there has been no further announcement about that from HMRC. What is required and what is this functionally compatible software? Functionally compatible software is defined as a software, either a product or an application, which does three things. It must record and preserve the digital records. It must provide HMRC with the information and the VAT returns from those digital records using the API platform, and it must be capable of receiving information from HMRC, again, via the API platform. HMRC is not itself releasing any software that will be able to be utilised by businesses. There is a list available on the HMRC website of approved suppliers who have tested their software with the HMRC system, and HMRC has confirmed that those software providers, their system is acceptable and they can be used. So it is necessary, therefore, to have some form of software. Generally, it should be available from your existing software provider. If that is not available, it is possible to purchase separately bridging software that can complete the last stage of the process. But the important thing is that the link, the API, not only must be capable of sending information to HMRC, it is also required to be able to receive information from HMRC. There has been a lot of discussion about whether this will allow HMRC to remotely review accounting records. HMRC confirmed yesterday in a webinar that this API will not be a permanently open link and that at present they will not be able to remotely interrogate records. However, I think many people and most people expect that these systems will develop and that there will be further requirements imposed on businesses by HMRC in later years, and that there will possibly be further phases to making tax digital, and that may include the ability for allowing HMRC to remotely interrogate records. So HMRC says the API, as well as sending information, must be able to receive information, but currently HMRC is saying the information that will be received is simply confirmation that, for example, your repayment has been authorised and that it has been released to your bank account. There was an initial discussion as to whether software and spreadsheets could be a component of the functionally compatible software, and that is possible as long as there is suitable bridging software or some other capability to submit the information from that spreadsheet to HMRC. Similarly, all digital records do not all have to be held in one place or in one computer program. It is possible, for example, to have a different program for your accounts receivable than for your accounts payable. As long as they are kept in a number of compatible digital formats, that is acceptable, and as long as from 2020 all of the information that flows through to the VAT return is digitally linked. The next slide just shows a little bit of information about the digital record keeping and what is required. Reverse charge transactions do need to be recorded, and HMRC has confirmed that they should be recorded twice, once as a supply made and the second supply as an input tax claim. Because these are technically two transactions for VAT purposes, you are deemed to make the supply to yourself. There's an output tax charge and an output, and then you are entitled to recover a set amount of input tax. There's an input tax claim and a value of inputs. HMRC has said that the data that must be contained in the functionally compatible software is the information which is shown on the bottom of the slide. Most of it is quite self-explanatory. HMRC has confirmed that you only have to record the amount of input tax that is actually claimable on the business purchases. This is a relief to many businesses which are very heavily exempt and have made a decision not to bother reclaiming any VAT on their expenses, as there was previously a concern that they would have to record both the amount of VAT shown on the invoice and then the fact that they were not reclaiming any of it. HMRC has now confirmed that you only need to recover or show in the digital record the total amount of input tax claimable on the purchases. And as it mentions at the bottom, any other adjustment needs to be shown. There was a concern originally that if you made adjustments, for example, if you received invoices late or you'd made a mistake in entering the value of an invoice or the amount of VAT to be recovered, that there would have been a requirement to go back and adjust the original digital record. HMRC has now confirmed that you can put these through as separate one-line adjustments, as long as those adjustments are shown in the functionally compatible software. You do not need to show all the details of the calculation. So this will apply to issues such as late purchase invoices, but also any business that is required to make a partial exemption calculation. Only the resulting adjustment needs to be kept within the digital record. There is no requirement that the whole of the calculation is kept within the digital record. That can be separately kept and just the final adjustment put in, potentially as a journal adjustment into the records. Obviously, there is a need for these records to be retained. It is just that they now no longer need to be retained within the digital record. HMRC has given some explanation of what will be required when they talk about digital links, which is the requirement which would be mandated from 2020. The digital link is a means of transmitting or transferring data without the need for any form of manual intervention. HMRC is concerned that many errors occur in VAT returns as the basis of information being rekeyed, and part of the rationale for making tax digital is to reduce rekeying and hopefully reducing the errors. So the digital link must transfer the information without any sort of manual information. It's not possible, HMRC has said, for example, to cut and paste data. That is specifically covered in the leaflet, which does, for this purpose, have the force of law. But other forms of digital link which are acceptable are having linked cells in spreadsheets. Emailing a spreadsheet which contains a digital record is acceptable. Surprisingly, transferring records on a digital portable pen drive or memory stick would be acceptable as ensuring that the digital link exists. Import and export of data together with automatic data transfer will all be acceptable, but whatever means is used, there is a requirement that from 2020 all data must be digitally linked and that the information must not be copied over or have any manual transposition of the data. Having explained a little bit about what HMRC's requirements are, what sort of things do we need to think about? What sort of things do we need to consider about our VAT returns in respect of making tax digital? Firstly, ensuring we are aware which VAT registrations are actually in place and which of those are going to be covered by the first stage of making tax digital. Do we know, are we sure what the VAT return periods are for each of these returns? How is our current financial reporting system going to be able to cope with making tax digital? Have we spoken to our software provider to ensure that we will be able to transmit this information to HMRC next year without it being rekeyed? If we're using spreadsheets, how is the data input into that spreadsheet and how does it finally get through to HMRC? It's particularly relevant if we have some spreadsheets which have been used in the business for a number of years. Are we sure we know exactly what that spreadsheet is doing? How does the calculations in each of the cells work? And I think the important thing is we need to speak to our software provider because many of them will take time to introduce any of this changes, the necessary digital links and the necessary API to transmit the system to HMRC. And if you are looking to change your software provider, as you are well aware, this will often take a lot of time and takes more time than you may well think. The final point to consider is what is the standard of your record keeping? all of your records are going to have to be digitally linked, and it is now a good time to start thinking about the standard of the record keeping, thinking that possibly in some later phases HMRC may wish to enact legislation which will allow them to look at information electronically, potentially without the need to give you any further information. So that is something for the future. So the two things to remember is we have a requirement from April or October next year to submit the information to HMRC electronically using an API, and from April 2020 there is a need for the information all to be digitally linked so that it all flows through to the final VAT return and through to HMRC. Turning now to the position on Brexit, we are all very well aware about the political discussions that are going on at the moment. HMRC, though, has published what they have called no-deal papers, and these set out the government's position covering a large number of areas. What would be the position if there is no deal and we leave the EU without anything specifically agreed? As I said, they cover a large number of areas, cover things like medicines, the treatment of pet passports. There is one which covers VAT, and reading through that, there are no major planned changes for services. We would still expect that there should be no VAT on supplies made to businesses in other EU member states, because under the previous rules, before the single market was introduced, we had a relief from VAT, or there was a zero rating for the supply of professional services to businesses in other countries outside the UK, and that is probably likely to continue, but we are waiting for the exact confirmation about how that will be enacted. There are many changes, though, which will affect businesses which make imports or exports, people that bring in goods from the EU or people who export goods to the EU who've not had to deal with customs entry before, and they have therefore got no experience of completing customs entries because they have not been required. Many professional firms will think that they probably are not going to be affected by these changes, but many large firms may often buy sort of stationery or IT equipment centrally and then send it out to their various offices in other countries. And if that is the case, there will be a need to consider these movements to EU countries or movement of goods from EU countries, as going forward, once any transitional period has ended, those will be treated as imports and exports, and there will be a need for the necessary customs entries to be completed. We think there may be some changes more for businesses that operate within the financial services sector. There could be some changes to the specified services order, which allows these businesses to recover VAT in respect of some specified exempt supplies. We have seen some changes already in this order this year, as HMRC has been reacting to cases which have been progressing through the courts, and it is possible that there would be some further changes in the financial services sector, but we are not expecting many changes for the professional services sector. There will be some changes, though, which will affect particularly our clients who operate throughout Europe. Any client who needs to register for VAT in the EU will find that they may have to provide the tax authorities with a fiscal representative going forward. Whilst we have been in the EU, fiscal representatives have not been required. But once the UK is no longer a member state, there may well be a requirement for fiscal representatives to be appointed as a condition of being VAT registered. Fiscal representatives generally are jointly and severally liable for the payment of VAT to the tax authorities, so therefore a number of limited firms offer this service and to charge quite a high fee for doing so. Businesses that supply electronic services and may be registered under the mini one-stop shop in the UK will need to re-register in an EU country under what is called the non-union schemes. They would have to think about where they wish to register. Any client who happens to be a tour operator will be affected because they will no longer have the benefit of the tour operator's margin scheme and may need to register for VAT in a number of countries where they supply holiday packages. One good point about Brexit, it will be likely that EC sales lists and Intrastat returns will no longer be required, which will be good news for many businesses because, as you are well aware, the Intrastat regime has a criminal penalty for non-submission. VAT and disbursements is an issue which comes up quite a lot, and this slide just talks about the conditions which need to be met for HMRC to consider a payment to be a disbursement for VAT purposes. The important point to make is that it differs to the definition which is applied to legal bills for what counts as a disbursement. HMRC says that each of these 8 conditions need to be met for a payment to be a disbursement. Ones which definitely meet the conditions would be payment of SDLT or payment of land registry fees on behalf of a client. But issues like search fees and travel fees do not meet the definition. There has been no recent change in HMRC's policy on disbursements, but we are aware of a lot more interest from HMRC on treatment by professional firms of disbursements. The reason for this is that there was a case called Brabner's, which was a firm of solicitors in the north of England, who were challenged by HMRC as to the VAT treatment of property search fees. The case was so important that the Law Society actually intervened in the hearing before the first-tier tax tribunal. The tribunal, though, eventually decided, after reviewing the legislation and HMRC's policy, that property search fees are part of the value of the supply that is made by the professional firm. And the reason for this is that they consider that that search fee is used by the firm in part of its onward supply to the client. It is not something which is simply passed on, or it is not something simply which the client has a responsibility to pay, such as SDLT. The reason why it has become rather an issue now, as I said, there is no change in HMRC's policy, is that a number of clients have received letters from HMRC, and HMRC is asking firms to review their treatment of disbursements and property search fees for the last 4 years. There is a risk that HMRC will also look to impose penalties if they find that firms have been treating it incorrectly. There could be an argument that HMRC could impose a 70% penalty because you have arguably gone against HMRC's published policy, which would allow HMRC to argue this is a deliberate error, though it is much more likely that penalties HMRC would look at would be 30%. And we have had a number of successes with HMRC arguing that it is a complex area and therefore penalties should not be imposed at all. It is just to be aware, though, that it is an area HMRC is looking at in some detail. They have written to a number of businesses about the issue, and there is a specific HMRC team looking at the issue of disbursements in professional firms. The next change about VAT grouping was announced in this year's budget. It was something which has been in discussion for a number of years. Currently, only corporate entities are allowed to join a VAT group. So that would be companies, LLPs, or bodies such as corporation sole. But you have to be a corporate entity currently to join a VAT group. HMRC is proposing that from April 2019, general partnerships and sole traders will be able to join a VAT group. They will still need to be established in either the UK or the Isle of Man, as is currently required for corporate entities, but partnerships and sole traders will be required to be in business and trading to be allowed to join a VAT group. That differs from corporates who are not required to be trading to be in a VAT group, and it is possible to have dormant companies in a VAT group. There are a number of advantages in having a VAT group, not least that you have just one VAT return to complete for the whole group, because for VAT purposes you are treated as a single entity, and any supplies that are made between members of the VAT group are disregarded for VAT purposes, i.e. no VAT is charged on supplies between members of a VAT group. The group is looked at one entity, and any VAT recovery position is looked at for the group as a whole. One downside of a VAT group is that there is a joint and several liability for VAT debts. So if one member of a group owes a VAT debt to HMRC, it is possible for HMRC to go after the other members for payment of that VAT debt. It is not too complex to form a VAT group. It is the submission of 3 forms to HMRC, a VAT 1, a VAT 50 to form the VAT group, and a VAT 51 with details of members of the VAT group. The important thing, though, is that a VAT group is then issued with a new VAT number, and it is not possible to transfer your existing VAT number over to a VAT group. That may have some advantages, that if you are in, for example, the default surcharge regime, that clock will be reset and you will start again without any defaults. But if you have any special agreements with HMRC, such as a partial exemption special method, that would need to be renegotiated. And if you import goods, you will need to apply again to have a number to allow you to import goods into the UK. So grouping will be allowed from partnerships and sole traders from April 2019 as long as those entities are trading. Frequent questions are always asked to us about place of supply questions for VAT. And it's important because this determines where VAT is charged and, more importantly, who actually then accounts for the VAT. Generally, on business-to-business transactions, they are liable to VAT where the business customer is based. Therefore, if you supply general professional services to a business based outside the UK, you do not have to charge VAT. However, the situation on land-related services is different, and these services are always taxed where the land is located. We have seen a lot more interest from HMRC in whether the correct treatment is being applied to land-related services. There was some clarification issued by the EU as a series of implementing regulations in 2013, and these have clarified what is a land-related services and therefore liable to VAT where the land is located, and what is not a land-related service liable to the general rule. It becomes quite an issue. The attack we are seeing is on recipients of services where services have been incorrectly treated as land-related services and where HMRC says they should be general rule services and therefore no VAT should be charged. So you have a situation potentially with offshore landlords where HMRC have said these are not land-related services, you should not have been charged and therefore should not have recovered VAT on these services. And recipients have been told that they are recovering VAT in error by HMRC, and we have seen situations where HMRC has looked to impose penalties on the recipients of such services where VAT has been charged incorrectly because the supplier has treated them as a land-related service and the land is located in the UK. There may be no tax loss, but HMRC would look to charge penalties on the recipient because of HMRC is looking for correct behaviour. The next slide just defines some services which are definitely land-related services. Land-related services generally are those that alter the physical or the legal characteristics of the building. So things such as drawing up of plans, construction, security, property management, and those sort of ones, or legal services that change the transfer of title or establish certain interests are all land-related services. And if the land is in the UK, VAT should be correctly charged. The next slide just talks about services which are not generally seen as land-related services. So, advice on the terms of a property contract, if it's not part of the actual conveyance, is not seen as being a land-related transaction. Advice on enforcing a contract, again, not a land-related service. And finally, general asset management, as opposed to property management, is seen by HMRC as not being land-related. So if you have a business which manages the whole assets of a business, but may not do the actual physical property management, the asset management service is not seen as land-related, and therefore for an offshore landlord would not be liable to VAT. And this is the area where we have seen HMRC attacking offshore landlords. Deal fees is a topic which has been a hot topic for many months, but thankfully we now have a fair amount of clarification as to the VAT treatment of deal fees. This slide just talks about how deal fees can be treated and how a BDO is able to recover VAT. HMRC says that the company must have contracted for the supply, and HMRC does accept that this may be by novation of the existing contract to the BDO. I am aware, though, that novation is quite a complex term and may not necessarily legally mean what HMRC thinks that it means by that term, but they must have an interest in contracting for the supply, they must make use of the supply, pay for the supply, and hold an invoice in its name. But then, importantly, HMRC says that BDO must either make supplies of management services to its subsidiaries so that the costs can be attributed to those costs, or it must be part of the general supplies of the group as a whole. And the requirement for a recharge of management services is required by HMRC even if BDO is going to be grouped with its subsidiaries. Any consideration paid for these management services must be what HMRC says is genuine and more than nominal. So therefore it's not going to be possible just to recharge these costs at a £1 value. They must have a genuine value, and it cannot be contingent on any future profitability of the subsidiaries. This stems from a case called Norseman Gold, where the tribunal said that fees which were contingent on future profitability did not allow VAT recovery. If you have a situation where there are a number of subsidiaries, some are charged and some are not, input tax recovery will only be allowed where there is a charge made, and where there is no charge made, input tax will be restricted. So I don't think there has been much change. It is just the welcome clarification about what needs to be done to allow recovery of VAT on deal fees. In the next bit, I just want to pick up on two main issues that HMRC will always pick up on VAT visits. And having sat in on a number of VAT visits, I can confirm that this is something HMRC will always want to talk about. It's the issue of aged creditors and entertainment, and then the associated risk of penalties. There is a requirement that if you have a purchase invoice on which you have recovered VAT, if that invoice is not paid within 6 months of the payment date, you are required to automatically adjust the input tax claim. You're entitled to recover the VAT as soon as you receive the invoice, even without paying it, but if it is still unpaid after 6 months, you are required to adjust your VAT claim. You might be aware that there is a similar optional adjustment called bad debt relief, which exists for your sales invoices. So if a customer hasn't paid you after 6 months, you may adjust your output tax claim, but the input tax claim is automatic. It does not rely on whether there has been any claim for bad debt relief on the other side. It is a compulsory adjustment. We see HMRC in advance asking for reports to be prepared which show your list of aged creditors. HMRC simply then, at their meeting, go down to those that are more than 6 months and ask to see evidence that the input tax has been adjusted. We are seeing many cases where HMRC are now assessing for penalties where this adjustment has not been made. And it is possible even to have a penalty issued where there could be no tax at stake. You could have been required, for example, to adjust your input tax in month 6 because it was unpaid, but you may then be entitled in month 10, for example, to recover the VAT again because the invoice has been paid by that time. So in such a situation, there would be no tax loss to HMRC, but HMRC will argue that penalties would still be applicable if the invoice had not been adjusted correctly at month 6. And penalties are not, in HMRC's view, to do with tax loss, they are to do with behaviour. And if you have been careless, HMRC will argue that a penalty should apply. The other big topic which HMRC will always want to ask about on visits is the question of entertainment. There is nothing particularly new about the rules on entertainment. It is just simply something HMRC will often ask about. They will often pick it up by asking to go through expense claims or similar. They may ask for partners' expense claims and so do an exercise looking at those to try and pick up entertainment expenses. The issue being that entertainment of non-UK clients is not recoverable for VAT purposes. Entertainment of non-UK clients, though, however, is recoverable, but there is a but that HMRC says that it is only recoverable if the level of cost is reasonable, and this is likely to be very, very limited. Because of this sort of block on recovery and the limit on recoverability for non-UK clients, it is the reason why HMRC will wish to look at this quite often. Having said that entertainment for non-UK clients is not recoverable, staff entertainment for VAT purposes is recoverable in full. For VAT purposes, there is no monetary limit, and there is not a limit either for how often this entertainment happens. You're not limited for VAT purposes to just the Christmas party or one event a year, though there may be restrictions for direct tax purposes. And similarly, for VAT purposes, if the business funds the entertainment regularly, that is recoverable, and that is also able to include purchases of alcohol. The aim is that HMRC accepts now that it is to increase the morale and welfare of the staff, and it is therefore a legitimate business expense. What, however, is not recoverable is partner entertainment. HMRC has won a number of cases before the tribunal where they were successfully able to argue that partners did not need to be entertained because they did not need to have their morale improved because they were owners of the firm. So partner entertainment is not recoverable. Sorry, Anna.
Trying to suppress my laughing.
That's it. It is acceptable, though, to recover sort of any business element of a partner event. So if you have a partner away day when you are discussing business strategy, the costs of that part of the business element you would be able to argue would be recoverable. But any form of entertainment, like an evening meal or any other entertainment or accommodation, would not be recoverable. That is for partners. So if partners are there with staff, it is still recoverable in full. It is just partner-only events where the entertainment element is non-recoverable. The other thing just to talk about is HMRC's increased use of penalties. HMRC looks for penalties as a means of increasing compliance, and HMRC's view is that penalties are there to avoid a business being careless in their treatment of VAT. We have the same penalties in VAT which exist for the whole of the tax system. You have the 30% penalty for behaviour which is careless, and it is possible for that penalty to be mitigated. There is then the penalty for 70% error if you make a deliberate error which is not concealed, and then the final penalty of 100%, which is for an error which is deliberate and concealed, which is the penalty for people involved in fraudulent transactions. We generally only see penalties being imposed at the 30% level in general day-to-day business, and as I said, that penalty, it is possible for it to be mitigated. If you disclose an error to HMRC while HMRC is not looking into your VAT affairs, you would get an automatic 50% mitigation of that penalty. So the maximum penalty you would be looking at would be 15%, and it is then possible to mitigate that penalty further. Further grounds on which it is possible to mitigate the penalty is by able to demonstrate that you have taken reasonable care. So, for example, if you have written procedures in place to show how VAT should be treated and an error arises despite having those written procedures in place, HMRC will accept that you have taken reasonable care. Similarly, if you have provided training for tax staff about the way to deal with invoicing, the way to deal with VAT accounting, that again all shows that you have taken reasonable care. Because HMRC is looking to penalise those people who have been careless in their VAT accounting. Also, if you can show that it is a complex area, it is possible to get the penalty mitigated. And similarly, if you have taken advice on the issue, even if that advice eventually turns out to be incorrect, that will help in any mitigation of penalties. The issue is, though, that HMRC is very much going out looking for penalties, and their starting position is generally that there will be a penalty for any VAT error that they discover unless you can explain to them why the penalty should not apply. The last thing I just want to pick up on are a few other issues which are out there in the general business area, which may not affect professional firms as much as the other things. But there are changes to the rules on vouchers which will come into force from January 2019, affect things like face value vouchers such as a retailer voucher from Marks & Spencer's or John Lewis. Generally speaking, these vouchers, there will be no VAT charged on them because the new rules say that they are not to be regarded as a supply for VAT purposes from January 2019. Certain vouchers will still have VAT, but those will be vouchers which can only be used to purchase one type of purchase. Something which has been announced and has been in discussion for a number of years is that HMRC is finally pressing forward with a reverse charge domestically for supplies of construction services. This will come in from October 2019 and will only affect those businesses which supply on construction services. If you buy in and supply on construction services from October 2019, there will be a reverse charge, but it will not apply if you use the construction services within your own business. We had two further announcements in the budget for which HMRC is going to provide some further information, but nothing further has yet been provided. There is what HMRC refers to as unfulfilled supplies. These are situations like hotel rooms where people pay a deposit in advance and never actually turn up. At the moment, that can be treated as compensation and not liable to VAT, but there has been some competing case law in the area of flights where courts have ruled that VAT should be accounted for. So HMRC has announced that the legislation will change, but as of yet, nothing further has been announced. And similarly, HMRC announced changes will be introduced for credit notes. Again, we have nothing further, but we think they may be looking to try and limit all credit notes to 4 years, because at present, if you change the value of your supply, there is no current time limit. as I said, there has been no announcement about those two last supplies. So that sort of picks up the issues we wanted to talk about on VAT, the two big ones being MTD and the effect of Brexit. There are a number of the other VAT issues that we have picked up.
Fabulous. Thank you very much, Michael. So quite a lot in there to be going on with. A couple of questions also. So following the House of Lords Committee criticism of the introduction of Making Tax Digital, and they're not the only ones criticising, we're aware. Do you think there are going to be any further delay in the introduction of Making Tax Digital?
It's quite difficult. The House of Lords was quite scathing, and they said that it will fall quite badly on smaller businesses, particularly because they are the ones which will be coming in from the 1st of April. I think HMRC were quite upset by the criticism, and I think the issue is that the Minister has previously stood up in the House of Commons and said Making Tax Digital is coming in for VAT from the 1st of April. So I think it will come in. I think some of it might get delayed, maybe the digital links might be delayed, but some parts of it, I think, will be coming in, yes.
Yeah, and we're seeing a lot of pushback on the direct tax.
That's right, I know, on direct tax, quite a lot of it has been pushed back.
Indeed. Okay, and you mentioned vouchers and the changing in terms of what will affect firms that offer salary sacrifice.
That's right, yes, because currently, under a salary sacrifice arrangement, if you sort of provide vouchers which have VAT on, such as a retailer voucher, you reclaim the VAT when you purchase them, but you then have to account for VAT when you provide that voucher to your employee under the salary sacrifice arrangement. From January, that will change because there will no longer be any VAT on these vouchers. So it's a case of just adopting your accounting system so that you don't pick up the VAT on the purchase and you're no longer accounting for VAT on the sale of these vouchers. This only affects vouchers, so like your face value gift vouchers. Childcare vouchers have always been exempt from VAT.
Right, okay. And you mentioned construction services and the changes there and the introduction of the reverse charge. What sort of construction services are we talking about here?
It is generally what you would normally think of as normal building services. People building civil engineering type work. So your big civil engineering contractors who use a number of subcontractors, like house builders may use like a number of a separate electrician, a separate plumber. So the main contractor is the one that will be affected going forward. These subcontractors will no longer be charging VAT, and the main contractor will apply a reverse charge on these services.
Right, so quite a big change there.
It's a very big change for that sector, and has quite a big effect on things like their cash flow for these smaller businesses, because they will no longer be getting the VAT in their bank accounts for 2 or 3 months. Yeah. So it will affect their working capital, yes. Yeah,
and a sector that's already squeezed on that
side. In a sector that's very squeezed, yes.
Okay, and unsurprisingly, a question about Brabner's.
Yes.
So there's a question here about disbursements, and there's obviously a logic here that Brabner's case was on something very specific, but the logic can be applied to other expenses. So should we be applying the logic?
I think we probably should. One thing you do not have to apply to is medical fees in a sort of personal injury claim, because there is a separate tribunal which decided that those were genuine disbursements for VAT purposes. I would have thought that it should probably be looked at the other disbursements that are applied. The HMRC letters we have seen do mention looking at the treatment of other disbursements as well, though it does initially only mention Brabner's.
Yeah, okay. So it's a case of actually being very specific about what the items are.
What are the disbursements that are being recharged? Some of them will genuinely be disbursements. Companies' house fees always been accepted as disbursement. Medical fees, they've now, by tribunal, decided to be a disbursement. But property search fees, there has always been this dispute. The Law Society has never agreed that they are with HMRC's interpretation, but yeah, it is. The tribunal says they are now part of the supply. Yeah. As I said, HMRC is writing to firms asking them to review their treatment.
Yeah, but it's important to get it right, because you don't want to apply VAT to items that you shouldn't be applying to.
That's right.
Equally as bad.
That is equally as bad, because that could cause problems, either increasing the fee by 20% on those items, or causing problems for the recipient if they incorrectly try and recover that VAT.
Yeah, absolutely. And what happens with, what are we saying to clients that haven't necessarily already been approached on this matter by HMRC? Should they be thinking about doing something without being requested?
Very much so, because if HMRC come out and look at it, there is a risk that they will impose a higher level of penalty because they will say it is a prompted disclosure. If you're able to identify any error now and disclose it, you will get a relief from HMRC mitigation for making an unprompted disclosure, and you could probably be able to argue it is a complex area, you've done a reasonable way of dealing with it, and you could potentially get away without any penalty. So I would probably recommend that you do review all of them, even if HMRC has not contacted you as of yet.
Yeah, there's definitely a trend of HMRC looking for the right level of review and thought put in, as well as making sure it's correct.
Correct, yes.
The processes and procedures.
Correct. And the other thing is, if HMRC do discover this error, it means they may start thinking what other errors are there that they could look at as well.
Yes, okay. Okay, well, I'm sure we could go on forever talking about VAT, and as much as I'd love that, I'm not sure the audience have probably got another job to go and do. So thank you very much, Michael. Really appreciate your time and the expertise that you've brought to the conversation. If there are any further questions, please do get through to us, ask any questions that you would like, and we'll try and get back to you. Just so that you know, the next webinar we have is on the 27th of February, where we'll be hearing from BDO China on a tax update on Chinese matters. So I'm sure that will add some additional complexities to matters as well. So again, thank you very much for our listeners, and to you, Michael. Appreciate it, and I look forward to speaking to you.